Hello everyone, I am Ankita Pathak from Angel One Wealth and I am happy to introduce to you the Investing Pantheon, our flagship offering that aims to address the most important topics around investing. Like the ancient Pantheon, it harmonizes timeless wisdom in our own modern ways. In this edition, we will deep dive into factors that will paint investing macroscope in coming months. With Fed rate action already behind us, we believe US elections and its repercussions on China, India and rest of the world will be the important events to track. So before we start, let's deep dive into this topic. It is important for us to understand what are the two manifestos, that is, what are they saying and what entails the global economies when either Kamala Harris or Donald Trump comes into the power. The most important and the most talked about is, of course, tax and tariffs. So starting with tax, Kamala Harris's manifesto says to increase the corporate tax rate to 28%, whereas Trump promises to keep it at 21%. Capital gains, the promise of Trump is to possibly keep it capped at 15%, whereas Kamala Harris says that for the wealthiest of the individuals, it could be taxed at the income tax rate, which can be as high as 37%. Similarly, on the tariff bit, while Kamala Harris says she wants to focus on negotiations and diplomacy to ensure fair trade, Trump is more of the opinion of increasing tariffs. And the current talk is 60% tariff on goods imported from China and 10% from the goods imported from rest of the world. Apparently, there is also a case when the rest of the world could retaliate and could rather say that US's exports to rest of the world will also be at a tariff, and what it leads to is a lower global trade and lower global growth as a whole. So all of this and more are very important for us to track, to understand that once either party comes into the power, what is the promise they are making. Now, what will happen in the US elections is of course anyone's guess, but the polls are pointing towards the victory of Kamala Harris, but not to forget that in 2016 also they were pointing towards the victory of Hillary Clinton. The markets are, however, a little divided. While we fully understand that market volatility can be because of the factors just beyond elections, so it could be because of the geopolitics, it could be because of the carry trade unwinding that we saw on the Monday of 5th of August. But if we were to look at volatility, the 3-month prior volatility as we know today, the high volatility points at anti-incumbency. So while the polls are more aligned towards Democrats coming back into the power once again, the markets are pointing otherwise. If we look at their impact on the economy and the markets, it is the Democrats that the economy likes the most. So the difference between real GDP growth we've seen in Democrats is higher by about 100 basis points versus the Republicans. However, Republicans tend to make the market happy. So policies of free market, lower taxes, and good investor sentiments do better under the regime of Republicans. Democrats tend to do better with the economy as well. One easy way to measure this is misery index, which is the sum of unemployment and inflation, which is a dual mandate of any government. It has some predictive power, as party in power is penalized when the index is high and is rewarded when the index is low. In the last tenure of the Democrats, that index did inch up because we had high unemployment, we had high inflation. So that says something about the tenure and re-election of the Democrats, but also says that if they come back in power, they would want to curb inflation and unemployment very, very aggressively. Democrats also tend to prefer healthcare and housing for all. Their healthcare expenditure is percentage on GDP, or even the housing prices seen under their regime. The healthcare expenditure is higher, whereas the housing prices are lower. Republicans, on the other hand, are more inclined towards free market and market dynamics deciding these factors. Now, we are entering the US elections at cyclically high valuations. If you look at all valuations in the history of US markets, this is one of the higher valuations that we are at, barring the big bubbles. Whereas on the interest rates, which have structurally been coming down, we are still at short-term high interest rates today. And Fed has started to cut rates, but it will be interesting to see once we go through these cycles and once the US elections are past us, where do the valuations go, especially if US can avoid a recession, which is also a big possibility. Now, in the past, Republicans have always opted for corporate tax cut rates. The two big corporate tax cut that we've seen in the history of US has been brought about by the Republicans, which means that their profit after taxes tends to be inflated, and it is good for the earnings of the US companies. There is a difference between numbers and narratives. So Donald Trump is positioned to be a pro-fossil fuel kind of a person, but I think in true sense he is just pro-markets. He has pushed the production of fossil fuels and crude oil, no doubt about it, but he hasn't taken away the benefits for clean energy, such as investment tax credit for solar energy or production tax credit for wind. Plus, he never interferes with the state level or a firm level initiatives. They tend to blossom under Trump, and therefore the clean energy cycle has done much better under the Trump regime. So all of this is determined by global demand and supply beyond the party who is in power. But we think it is important to keep in mind the lens of what's the narrative and what the numbers are saying. Other US sectors, let's look at financials, where Trump is vouching for lower regulations, where Kamala Harris wants to stringent the regulations both in financials as well as in technology. Overall, the sectors which are not exposed to higher tariff rates and which can rather substitute US domestic demand because of the high tariff rates, think steel, paper, etc., will tend to benefit. And also the sectors which are not affected by tariffs, like defensives, consumer staples, which consumers are going to consume any which ways, are the sectors that one should tilt their portfolio towards. Now, we've heard enough of US trying to be harsh on China. De-Chinization of America is also real. So China is holding less percentage of US treasuries. US imports from China has also fallen. So there is this clear divide between the two nations that is getting deeper. This piece and their contribution to global growth means that we will be in for a lot of volatility if the two big giants do not cooperate. India had a great chance last time to win from China Plus One strategy, and we did fantastic in certain sectors. The big winner here being electronic goods, where our exports have gone about 5x over the span of last 6 years. But there are other sectors where we had opportunities and we couldn't capitalize as much. I am thinking semiconductors, I am thinking auto ancillaries and so on. But over the last 6-8 years, we have put the effort, and if the world gives us one more chance, I think we are very prepared to take a bigger share in global exports. So the number of Indian companies who are saying that China Plus One strategy will play to their advantage is at an all-time high and increasing. And it's not baseless. It is an argument where India has put the effort. So we've done the PLI scheme where we have awarded the sectors which have a higher export potential. We have given manufacturing tax holiday for foreign companies coming to India. We have done the Make in India initiative and pushed to discourage imports in the country. We have had good push in the improving infrastructure and focusing on skill development initiatives. And finally, we have the Semicon program and India's semiconductor mission. So we are trying to fill in the global gap that is created because of the US-China rifle. And if India takes a share of this pie, it will be a huge benefit to India. But not to forget, India and China are also linked. India's FDI flows had started to fall after we did not allow Chinese companies to come in, and as a remedy, we have now allowed Chinese companies to come in with 51% majority stake being held by Indian companies, as we are seeing. And obviously, the trade between the two nations continues and is rather strong. So India's imports from China has gone up over time, and it is important economic interdependency between the two nations, because China looks to India as a growing market for expansion and a source of vital resources, and India now in turn relies on China for its raw material and various other input needs. Separately, the global central banks are now embarking on a rate cut cycle. We've had the big boss Fed cut at the 50 basis rate. Except Japan, all other economies are now cutting the rates. And the rate cut of 50 basis points raised the expectation that are we going to a recession, because why would Fed cut in such big chunks? Our sense is that it is not necessarily true. We are entering this rate cut cycle at a higher employment level. Our unemployment level is about 4.1%, which is lower than the previous cycles. The US GDP number, inflation number, job opening numbers are sufficiently robust, which goes to say that it is a big chance that US will not go into a very strong, deep recession, and therefore valuations could still remain afloat. Not to say that sector rotation, a mild time correction is not warranted. In India, I think the inflation tends to follow the US. There is a big commodities, which is a common chunk between them. However, India's inflation is more dominant by food, which is 45%, whereas US inflation is more dominant by shelter, which is about 36% of their basket, but roughly they tend to move in one direction. And with India's inflation below 4%, Fed cutting rate, I think it's a chance for RBI to also start cutting rate and keep the domestic economy buoyant. So we are likely to see that. Now, this was just a sneak peek into our investing Pantheon. We request you to go through the whole report, and we'd be happy to discuss, deliberate on this further. In essence, what we are saying is that US election will be the talk of the town, and it will lead to market volatility, new conjectures, and possibly even more surprises. Donald Trump and Kamala Harris are, of course, at different poles in their manifestos. Historically, economy has, like Democrats, markets have preferred Republicans, but anti-incumbency leads to a higher volatility in the market. China and rest of the world is vulnerable to US elections outcome. There will be a big shuffle in global trade as we know the outcome, as the tariffs come into place, as the supply chains move, and I think it will be an important indicator to watch in coming months. India can benefit. We are more prepared than we were in 2016. We have done the legwork to take advantage. Let's see how much of that fructifies. And in terms of asset allocation, going risk off makes more sense, which means within equities, choose defensive, use long-term bonds, hedge with gold, which still has more upside left. So that would be the crux of this edition of Investing Pantheon. Stay tuned for the next one. Thank you.